Welcome to this week's video, and in this week's video I want to take on an issue that a couple of people have asked me to take on, which is why all the fuss about the latest EU move in banking. All right? Well, in summary, what the EU have done is to say they are highly likely to enact legislation. They haven't quite got there yet, but they're highly likely to enact legislation, subject to a vote soon, that will see banking bonuses capped. Now, what they've done is to say that they would like to see, across all EU member states, banking bonuses limited to 1 times annual salary or twice with shareholder approval. So they've basically come in, targeted one particular aspect of banks, the bonus culture, and said that's what we want to change, and we're going to impose rules that apply to all banks within the EU. One of the key issues is enforcement of those rules, as we'll talk about in just a moment. So, is this the right way forward, and have the EU done the right thing? Well, I would say that there are 1 or 2 interesting, almost legal implications of the EU move, which I'll mention in just a moment, as to whether they've done the right thing. Yeah, this is a headline-grabbing measure. Attack the bonus culture, attack the risk-taking at the banks, the sort of activities that brought the banks to their knees only a few years ago. Yeah. Go for the bonus culture, go for those big bonus payments, the ones that made the headlines. I can see why the EU was tempted to target that area of banking, but in all honesty, I think they've kind of missed the target in many ways with this proposal. I'll explain what I mean in just a moment. So first of all, what is the proposal? What have they gone for? Well, just a bit of background here, and this isn't a video designed for HR specialists or anything like that, but just a little bit of background for beginners. If you're designing a remuneration scheme for your employees, whether you're a bank, whether you're a magazine, doesn't really matter, you've got essentially 3 tools at your disposal. And the EU's decided to target one particular part. So, if I'm a bank looking to pay, one of my employees, for example, there's an employee, what are my basic choices? Well, you've got obviously a salary. That's the way most people are paid in most organisations, okay? You've got the opportunity to top that up with a bonus. And then, of course, you've got various share-related payments, so shares or even share options. Right? So, I mean, there are several ways, potentially, that, in this case, bankers could be paid. And the EU's decided to focus very heavily on that bit. Bonuses. Right? Now, in banking, certainly bonuses form a bigger proportion, or have done in the past, of an employee's remuneration than in most other sectors. In some banks, The Economist has done some analysis on this, in some banks, the bonus could easily be as a multiple, 3 or 4 or even more times an employee's base salary. All right, so that's a pretty sizable chunk of the amount of money that an employee is taking home at the end of a given period. All right, but interesting that they've decided to target bonuses specifically. Okay, and of course, what the banks are basically doing is saying, well, if you're going to target bonuses, the banks aren't stupid, all right? They've seen this proposal potentially coming at them for some time. So what they've said is, well, fine, if you're going to cap the bonus that we can pay our staff at 1 times their salary or twice with shareholder approval, inevitably what starts to happen is the banks start to look at this and say, well, okay, in that case, to maintain the overall package that's paid to our employees, our star employees, we will simply boost their base salaries instead, okay? So, the EU's intentions might have been good ones in one sense, insofar as they want to end the sort of risk-taking culture that might have led to, banks almost collapsing, and some cases actually collapsing, and taxpayers' money being used to bail them out. But by just focusing on the one headline-grabbing bit of a banker's package, I think they've sort of missed a little bit of a trick. And of course, the banks are able and are to sort of wriggle around the edges. So, one option for the banks, and some of them started doing this, is simply to boost the base salary they pay their employees. And the EU hasn't really said anything about this bit down here. Now, is there a problem with boosting, before I get down here, the salary of the employees of a bank? Well, actually, 1 or 2 commentators have quite correctly pointed out that in a way, you're not solving anything, because yeah, okay, salary costs are slightly more predictable, they're fixed, there's less scope for the bank to sort of hike the amount that's paid to an employee by way of salary than, say, bonus, but you do introduce a degree of inflexibility by sort of almost forcing banks to take on all these big fixed costs in the form of salary rather than bonuses. Some commentators have argued, and I tend to agree, you take away the flexibility they need potentially to boost remuneration in good years and decrease it in bad years. Okay. Nonetheless, that's the route the EU's decided to go down. Down here, just worth a mention, you've got shares and share options. And again, a lot of the banks have said, well, if the EU is going to target that bit, we can start to do some creative things down here. Now, you can grant your employees packages of shares on a regular basis, for example, or you can give them share options. Just a word about shares and share options. People often think, well, it seems like the EU kind of agrees, that's a good way to remunerate your employees, because what that does is it aligns the interest of your employees with your shareholders. Okay, so we don't want to touch that because that's a good thing. But actually, in practice, is that such a fabulous thing? And the answer is, it's not perfect. All right. Number one, you get this problem with options. I won't turn this into a video on options specifically, but if I give my employee the right to buy shares in the future, rather than actually handing them the shares, and I give them a price at which they can buy those shares and so on, then you get a big difference sometimes between what's called the grant date for the options, the vesting date, and the exercise date. Again, that can create a certain amount of uncertainty for other shareholders in terms of what are called dilutive events, things that create more shares and can dilute existing shareholders. Because it's all very well saying, well, I'll give my employee the right to buy 1,000 shares in the bank, for argument's sake, at some point in the future, but in order to tie them in, I might require that that option isn't something they can exercise until later. That's called the vesting date. That's the earliest date potentially they could cash in their rights, if you like. And then, of course, I may not force them to do it then. They may have quite a big window when they can actually exercise the option. So what I'm saying is, it can create that kind of issue, quite a big gap between when the options are granted, when they're exercised, and as a shareholder looking at the account, you've got to be quite eagle-eyed to work out what's going on there. And also, people have said that it's all very well tying employees into share-based remuneration, but that creates a certain amount of short-termism. Okay, then all they want to do is boost the share price short-term, cash in, get out. Right? So interesting that the EU's decided to target bonuses. I suppose they're the things that sort of make the headlines. But I've got to say, for several reasons, I'm not sure this is a well thought through proposal. It's grabbing all the headlines, but I'm not sure it's particularly well thought through. Let me just summarise why. Number one, okay, this is the EU going straight into a matter that's normally reserved for the private sector. This is the EU dictating how private sector firms will pay their employees. Now, the Swiss have set a precedent on this with some of their latest corporate government rules, but nonetheless, this will come as quite a shock to some people to see the EU rolling its sleeves up and saying, effectively the state, defined as the EU, will now set boundaries on what private sector firms can pay their own employees. And that may yet, I say may yet, be subject to a legal challenge, but probably not. But nonetheless, it's quite a step forward. Number two, the EU has effectively isolated the UK on this one and is going to push this through regardless of what George Osborne might say or Boris Johnson by way of objection. Okay, it does hit the UK quite hard because obviously a big proportion of European financial services and the higher paid stuff, like derivatives for example, is centred in London. All right, so there's a couple of sort of interesting political ramifications of this. But on a practical level, is it the right suggestion? Is it the right thing to do in principle, even leaving aside those sort of worries for one moment? And I'm not sure it is. Number one, this doesn't apply globally. Banks will find a way. I mean, they just will. They employ the best accountants, the best lawyers and so on. That's just life. They will find a way around this, and some of them have been looking at a way around this already for their best top paying employees. They're not just going to watch them walk out the door. And those measures could include, obviously if this is just an EU-wide suggestion that bonuses are capped at 1 or 2 times salary, could include relocating them, Far East, US, wherever they need to go. Okay? One or two of the banks have also just said, well, we'll just look at boosting salaries or we'll look at share-based payments instead. And you might say, well, that's great. But I've already suggested in this video that actually there are pros and cons to salary, bonus and shares and options. It's not just a case that bonuses are bad and everything else is good. Okay? And the other thing is, I think they've really, number one, acted too late. I mean, most of the banks have started to water down bonuses a bit anyway in recognition of the fact they're making a wee bit less money than they were pre credit crunch days. So it is kind of shutting the gate after the horse has bolted to some extent. which is typical of regulators, by the way. And also, does it really solve the underlying problem? I think a better solution, but it's a more radical solution, would have been for the EU to just say, right, let's take away the bit of the bank that is riskiest, let's split it off. And I've talked about this in one or two other videos before, which I'll mention at the end. Let's split away investment banking, for example, or the bit that's most like hedge funds. Well, that lot can pay themselves what they want, how they want, when they want. But if they get it wrong, if they trade themselves into trouble, we let them fail. No taxpayers' money being involved, no bailouts, explicit or implicit. The risk takers are allowed to take risks, okay, and will fail on their own terms. If a hedge fund collapses, no one bails it out. If one of these investment banks collapses, no one bails it out. The rest of the bank, yeah, you split off the retail side of banking, if you want to call it that. I'm not saying it's risk-free. And there maybe you have a more almost civil service type salary structure. You know, most employees paid salary with a wee bit of bonus as top up. Bonus should also mean exactly that. Okay, so if an employee gets a 20% bonus, it should be only if they over deliver, not something that's just paid as a matter of course. All right. So, in summary, lots of headlines being generated. The EU's gone in and said, you know, we're taking away the bonus culture, we're attacking the bonus culture, we're doing something about it. I would argue that it's a wee bit late. Okay, I don't think they've gone far enough, in a way. And the result is going to be something of a fudge. And at the end of the day, the banks will, in an effort to keep their highest paid staff, find a way around it, as inevitably they always do. I look forward to seeing you next week.